This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performance does not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk, and there's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading. This is the JDfn Forex Report.
Good afternoon, traders. Hello, this is David Petrinick filling in for Scott Norris. The U.S. dollar ended last week with a bang. Since the beginning of the ECB conference last week, the euro-U.S. dollar has lost over 500 pips. From a chart perspective, the euro-U.S. dollar clearly broke its uptrend that it began holding since last August. The economic data that came out last week from the Eurozone was not healthy for Europe. In particular, the Italian GDP posted a decline of 0.3%. With Italy ranking fourth within the Euro economies, it would be safe to start expecting that the rest of Europe should soon be showing the same declines. If oil continues its sharp decline and inflation expectations start to fall, it would be expected that the ECB or European Central Bank would start to lower interest rates. Since the debt markets are currently not pricing a rate cut, you may want to watch the debt markets for a change in rate. If demand continues to decline on the global scene, the euro could start to reverse significantly against the pairs it rose against in the past 12 months. The U.S. dollar would gain strength in default to the euro losing value. The situation with Russia and Georgia is not helping Europe either. There is still a lot of speculation regarding whether this conflict will have an impact on the price of oil or not. In general, having Russia flex their muscles in Europe can not be a good thing for anybody except maybe Russia. With the U.S. economy still in bad shape, having the U.S. dollar rise is a nice positive, yet the U.S. dollar is still troubled, and the U.S. economy is still troubled. Housing prices are still in decline. Job growth is expected to stay in negative. The silver lining for the U.S. dollar is that the U.S. has already delivered a lot of bad news. So our good news is that the European economies and the Australian economies have not delivered their bad news. The U.S. has already taken its massive write-down in mortgage-backed securities, while the Europeans have not taken their write-down. In the next couple months, we are expecting large write-downs to come out of Australia, Europe, UK banks, and hedge funds. Currently, the biggest wild cards for the currency markets may just be our commodity buddies, oil and gold. If they continue to fall, then we should see the dollar continue its flight higher. The U.S. dollar has already made an impressive move against its competing currencies, so we may be near an end to the current dollar move. On the flip side, commodities tend to move sharper than most markets. In other words, they can correct a move that took years to form in only a few months, so a continued decline in commodities would not be out of the ordinary. The Great British Pound and UK economy has a mountain of numbers to be released this week, so expect some additional volatility for the Great British Pound. For the U.S. markets, we should watch the retail sales numbers on Wednesday and core CPI on Thursday. While many of the European pairs look extremely weak, we won't be getting a rate cut from the ECB anytime soon. In addition to the commodity market correction and the dollar rise, we are also seeing relief in the stock market. Financial markets and the chip stocks are also going up as well, and thus keenly waiting the retail numbers on Wednesday. Well, that's it for Monday. With David Petrinick. Expect to see Scott next week. You guys have a happy Monday. Happy trading.